Afternoon keynotes today. I'm Tim Fairchild. Four great things I mentioned just before we get started. One, I see a lot of my friends out in the audience. They're all over the place. And I see people I don't know, which means you're my potential friends. Third, I see a lot of students. And I love that this event has so many students on it because we need the best and brightest students focused on energy. And the fourth thing is we have three great speakers over the course of the next 90 minutes. There's no break in the middle. And so I'm going to get on with the introduction of Ray Spitzley. Ray is the vice chairman of the Global Power and Utility Group and the co-head of the energy transition for Morgan Stanley. He serves I just said that. Over the course of Ray's 40-year career, he's worked with companies and governments throughout North America, Europe, and Asia on power, energy, and other essential infrastructure. He's currently helping lead Morgan Stanley's Powering AI initiatives, and he's working with the leading hyperscalers, data center companies, and power providers to address the immense electricity requirements of AI-dedicated data centers. Ray joined Morgan Stanley in 1993 in Hong Kong, where he established the firm's power, energy, and infrastructure banking practice in non-Japan Asia. In 1998, Ray moved to Sydney, Australia, where he continued in that role while helping build out Morgan Stanley's investment banking division in Australia as the country co-head for IBD. In 2001, Ray returned to New York as a senior member of the Global Power and Utility Group. Ray has led privatizations in Australia, China, Indonesia, Philippines, Singapore, and Thailand. He's advised the Hong Kong government on its $25 billion port and airport development scheme. He helped lead the IPOs of Bloom Energy and Fluence Energy, led M&A transactions on behalf of a wide range of clients, including Advanced Power, AES, Algonquin, CMS, Connective, CPV, Cypress Creek, Dominion, DTE, Duke, Dynegy, Enbridge, NG, GIP, GPU, Hecate, ITC, Otachu, LS Power, Mitsui National Grid, Noble, NRG, PSEG, Puget, RRI, Silicon Ranch, and Singapore Power, Southern, and TC Energy. And I memorized that whole group. Who believes that? You know what this kind of reminds me of? This thing I'm reading reminds me of my passport from about 10 years ago, and I had that extension put in it, and it was about this long. That's kind of like reading this for you, Ray. So he has worked on multi-billion-dollar capital raisings for many of the aforementioned companies, as well as Calpine, Equinix, Sempra, and TVA. Ray is a graduate of Denison University, which was founded in 1831, and he holds a master's in public and private management from Yale University. Let's give a great warm welcome to Ray Spitzley.
Tim, that was very kind of you. I appreciate that introduction. And for the record, I was not part of the original graduating class from Denison. Look, it's a great pleasure to be here. From looking at the various topics this year at the conference, it's no surprise that a key theme has been AI. The size and scale of the power requirements necessary to support artificial intelligence has taken the power industry by surprise. And from my work with our large tech and data center clients, I know it has been a surprise to them that the U.S. power and utility industry was not waiting with tens and hundreds of spare gigawatts ready to be hooked up to their incredible new invention. As someone who has been a banker of the power industry, both here and overseas for the last 40 years, I view this moment in time with incredible excitement and anticipation for the possibilities in front of us. The title of my speech uses the word disruption, but the subtitle, which didn't make it up there, talks about the fact that this disruption, we believe, is actually mostly going to be for the good. I have way too many slides to get through here today. So I have taken the liberty of summarizing some of the key points that I want to make, both here up front and at the beginning of each of the section I will go through. My wife likes to remind me of how wordy and off track I can get. So in honor of her, I hope this helps. So there you have it. Oh, there's the subtitle, mostly for the better. So we do have that. We do have that on the record. I've highlighted here the one topic that is most challenging, and I have no doubt. I have highlighted in here in red the one topic that is most challenging. I have no doubt that we can solve any technical and financial issues associated with the challenge of powering AI. The real challenge is public policy. America's current electricity regulatory architecture was designed in the late 20th century when capacity additions were lumpier and competition efficiency was the primary goal. We need to figure out a better way to build the critical infrastructure in America that scales both AI and the clean energy transition. So I hope today's remarks and the others at this conference can help us in that goal. With that, let's take a quick glance at some of the key aspects of AI from my perspective. Of course, we start with the fact that AI is creating massive needs for new power, but what my Morgan Stanley equity research colleagues have recently pointed out is that any concerns about DeepSeek inhibiting the growth or profitability of AI is unfounded. And also, if past breakthrough tech developments are prologue, even with all of the hype around AI, we think that it is still likely underestimated. So this, let me throw in my version of what I'm sure you have seen as the estimates from a range of folks regarding the size of the power requirements, in quotes from 3 of the leading tech executives, all acknowledging that the challenge around power is key to realizing AI's potential. This next slide is more interesting. I don't understand any of the tech terms that are on this page. I don't know a flop from a flip, but what our equity research team believes is that despite whatever efficiency gains may occur in chip architecture over time, we still believe that each new generation of chips will require more power. So this problem of how do we find power is not going away. And it has implications for finding power not only at new sites, but as well as the increased power needs that are going to occur at existing data center sites as those locations get upgraded with the next generation of chips. So this is going to be a continual issue that we need to face. The next slide highlights the incredible cost of data centers and how small the cost of power is in relation. Every 1 gigawatt of data center core and shell and the GPUs that go inside costs approximately $35 billion, whereas the power equipment required to energize this is only around $2.4 billion. I'm just a humble power banker. We think $2.4 billion is a lot of money, so the scale of capital required here is truly enormous. One consequence of the enormous cost of the GPUs and their relative short depreciable life is that big tech companies can't afford to pay for them and then leave them idle. There is a significant incentive to pay more for power, which is what you see on the bottom part of this page, given its low relative cost. So there is a huge incentive to get those GPUs put to work. I'm going to skip this slide, get us to this next slide, which is truly the money slide in many ways for this presentation. It looks at how our research team has done the analysis across all of the potential revenue sources that they see big tech being able to gain from the adaptation of AI. And what is interesting to see, and perhaps is surprising to some of the skeptics out there, is that we see that there are enormous returns that are going to start being achieved relatively quickly. And by 2028, despite all the capital that is being spent, and I'll come back to that later, we see returns as high as 60% and over 60% from AI. So this is obviously going to mean that big tech is going to pursue this investment aggressively, and we have a long-lived issue to deal with. My final slide in this section addresses the issue of, is AI overhyped? Again, our tech analysts have prepared this slide, which looks back at other disruptive technologies over the years, which were similarly hyped. And while the timeline to full commercialization may have taken longer than original estimates, in aggregate, whether it's PCs, the internet, mobile phones, or the cloud, all of these, the initial bold assumptions about these latest developments turned out to underestimate the scale of adoption, typically by 30 to 40%. We believe the same will be true of AI. Next, I want to look at the growth rates for future power demand and what they mean in a historical context, and raise one critical risk factor. Actually, the biggest risk to rapid AI adoption, apart from any regulatory design issues I highlighted up front. And that is, do we have enough human capital in the power supply chain, whether it's engineers, EPC firms, or skilled construction workers, to make this all happen? Many of my clients who provide these services have real doubts about the ability to mobilize all of this so quickly, so I share this with you. If these concerns turn out to be true, then I think the timelines for achieving power and AI are going to get pushed out. Let's see if the other observation I have, which is also a product of my being a former history major, is that I am fascinated by the critical role Nope, I'm going back in time. This is not well. Here I am. I'm so sorry. Next, I want to look at what the growth rates are for future power demand and what they mean in historical context. You can see that we have the 2.4% growth rate, which is 6 times where we are with the growth rate that we've seen most recently. And that is part of the issue that I get at, that this is such an incredible increase of what we've seen versus time. We also see here that the sources of power demand are varied. So while AI is certainly a key part of what the future growth is in electricity, it's not the only thing that is driving power demand growth in the coming year. This slide highlights, if you look at the green shadings, well, it highlights the year-on-year growth that we have seen over time. And the green shadings shows those periods of time when there has been growth that is higher than the 2.4% that we expect going forward. And as you can see, the last time that we had that in this country was back in the 1980s, when I had a heck of a lot more hair. Now let's look back at the last time the U.S. power industry faced a crisis of sorts, at least from the perspective of the big C&I customers. In the late 70s and early 80s, the U.S. power industry found itself in a position of too much capacity, which had driven electricity prices too high. So the reforms that big industrial customers put through the political and regulatory process at that time was all about creating competition, reducing costs, and promoting efficiency. Following the UK model of deregulation, we created wholesale competitive markets in many parts of the country, which did indeed lower costs. However, the issue we now have, as seen here, is a challenge that is completely different. We have to figure out how much power we can build as quickly as possible to meet the demand of AI. This slide looks at a bottoms-up analysis of how much power is needed to support the expected sales of NVIDIA and other AI chips between now and 2028 versus how much new power capacity is actually getting built to serve this demand. As you can see, there is a significant shortfall of over 40 gigawatts between what's required and what is going to be available. This is a big problem. The next page summarizes part of this problem. Interconnection queues are too long and have only gotten worse over time, as I'm sure everyone in this room probably knows. Again, from my view, that is the regulatory architecture for such planning and CapEx approval that was designed to fight the last war, if you will, the war for efficiency. That system is inhibiting our growth, and it's also impacted supply chain for things like power transformers, as shown at the bottom. In the interest of time, I'm skipping over some pages that talk about a number of the different clean tech applications that are going to be motivated by big tech, recognizing that they have the need to deal with the carbon emissions that are going to be coming out from their data center. I am happy to take some questions about that in the Q&A, but I wanted to move on to where we are on some of the sources of supply, and that is the good news that we are in an all of the above situation. There's no need to fight about renewables versus fossil fuels or the relevance of clean tech solutions. We need it all. For those of you who are not fans of natural gas, however, please take comfort for the next few slides. First, shown here is one industry's consultant of the forecast for new capacity additions. There are plenty of carbon-free solutions on the horizon, as there should be. More interestingly, the next slide shows that markets are dynamic, and as such, proponents of solar and wind and storage should not fear the impact of reductions in IRA tax credits. Now, to be clear, I am not advocating for an IRA repeal. I am simply putting forth some analysis that I asked our research team to perform on the impact of relative levelized cost of energy calculations, given that new gas build is now so much more expensive than it was just a few years ago. That new build gas cost is on the right-hand side of this chart, and by our estimates, it now runs somewhere between $75 and $85 per megawatt hours. When you compare that, obviously, if we keep the IRA tax credits, we have no issue with renewable sources being cheaper than this. But even without those credits, solar is still less expensive than new gas. Solar plus new storage is right in the zip code, and wind, call it effectively a tie. So from a market perspective, there should be no incentive one way or another not to be able to justify renewables, even under a worst case scenario. There is one adjustment that I want to point out that we've made to these LCOEs that takes account of my contention for some time that the renewable industry's reliance on tax credits can create too much unnecessary uncertainty for investors. Our research team agrees, and the LCOEs you see here do include a calculation that talks about how the cost of capital can be reduced by the fact that if you have less volatility in expectations by investors for whether you will or will not receive your renewable credits, then the cost of capital for renewable providers will actually go down. Speaking of cost of capital, let me get on. I want to go back. I'm going to skip over. This is where I was supposed to tell you I'm skipping over a bunch of slides I can come back to later. But what I did want to talk about from all the clean tech solutions that we do see out there as getting commercialized as a result of the ability of big tech to pay up and the need for big tech to pay up for cleaning up the power that is out there. This is one vision of what we could look at in the future. What you can see here is, and I hope you appreciate the highly skilled graphics that we have laid out here. But this is the creation of what we would call an AI energy park that could be located in various parts of the country. Obviously, you'd need a significant amount of land to be able to do so, and a wealth of solar and wind and other endowments, but there are many of these locations that exist. And the idea would be that by building out such energy parks that have multiple hyperscaler tenants and the ability to utilize a number of existing and new technologies, that you can drive down cost by building these clusters together in a single location, and helping as well from the logistics of building this out, of doing so more rapidly. But enough of the tech stuff that I'm not very good at. Let's move on to the financial implications of AI. The amount of money that is needed by the tech industry for all of this spend is just massive. Here we look at the estimates of CapEx and R&D out to 2030 for just the top 4 companies, and it equates to over $4 trillion. When we then compare that to what renewable CapEx could be, that's another $1 trillion or more. So that gets to the issue of how does all this wind, solar, and battery CapEx get financed? Here is the big risk for our industry, or the table stakes required going forward. Renewable projects have to be able to generate greater returns in the future than they have historically, or risk getting crowded out by all of this AI and data center CapEx. The bar on the top left of this chart shows that data center developers are able to earn levered after-tax IRRs of 15 to 20% on the capital that they deploy. So that $35 billion that we talked about for every gigawatt. On the bottom, new gas plant developers are expecting at least 15%, if not closer to that 20% return that the data center providers are having. The problem, of course, is that historically, renewables have delivered returns that are much lower, sometimes as low as 7%, often no more than 12%. In a world where the people that allocate capital to real assets sit on top of all of these asset classes in total and have to decide where they're going to put their scarce capital to work, it's going to be very easy to say, I'm going to go to the data centers, I'm going to go to big tech, and I'm going to go to the gas projects, which are likely to earn higher returns. So we have to find a way to get that higher returns here. One, of course, easy for me to say, is looking on the right-hand side of the slide. This is just to remind you again of the profitability of big tech. Nothing wrong with that. Obviously, I'm a capitalist. These are all good Morgan Stanley clients. Delighted that they can earn the money that they do. But they do have substantial margins, anywhere from 35 to 70% operating margins that make their businesses extremely profitable. And as we talked about earlier, the return on investment from AI alone is quite significant. So we do believe that there is the ability, and ought to be the ability, to fund the investments that's required. This slide shows you a couple of remarks that have been made by some of the gas and nuclear IPPs, how they are waiting out. There is a bit of a stare down that is occurring out there between the hyperscalers who are looking to build some of these large new data center complexes and the existing large providers of power. We see that what these CEOs have been saying in their earnings calls is basically we're not going to capitulate to these lower returns that have historically been there in the renewables industry. We are going to be hanging out for the higher returns that we think our shareholders require. And they are under no obligation or need by their shareholders to pursue these projects unless they get the appropriate return on capital. So it's going to be interesting to see how this will continue. The need one way to drive higher returns in our sector is through consolidation. And if you need any reminder of the difference in scale between the tech industry and the power industry, here you have it. On the right-hand side is the aggregate market cap for the Magnificent Seven, which sits at roughly $15 trillion. On the left-hand side is the market cap for all of the publicly traded U.S. utilities and IPPs, and it gets to around $1.2, $1.3 trillion. So big tech is 10 times the market cap of our power industry, which, and there's 7 of them, 52, and I'll get to the private players in a moment. But that imbalance can't last. We need to get fewer players that can scale up in size to be more effective negotiators with big tech. This slide simply shows on the right-hand side that there's been a history of this consolidation that occurred previously on the gas IPP slide. This slide shows us that there are 28 different privately held companies in the renewable power industry today. Again, it's terrific that private capital has gone out and created all of these platforms and that we have so many players, but the competition among all of these players has helped create this issue of returns not being high enough. And with the need to raise all the capital that is out there, as well as we think that there will be a shrinking attention span from big tech, we need to see consolidation. This slide highlights how values have changed over the last couple of years between the heyday of some of the of renewable players from a few years ago versus today. One thing I would point out is not only have returns in the renewable sector been hurt by interest rates being higher, but again, this issue of will we get tax credits or not? I'd say that on the left-hand side, the resurgence in the stock prices of the conventional players shows you that when investors believe that there is growth and that there is real opportunity in this sector, they are going to come in in a big wave. So there is significant capital waiting on the sidelines that can be put to work, is the message from that. And here, when we drill down on renewable IPPs and some of the bigger players, you actually see that the market, whether it's in the standalone trading values of a Clearway or the implied values of the industry leader NextEra, the valuations that are implicit in a conglomerate like NextEra suggest that we actually are able to get quite healthy returns, notwithstanding some of the concerns that are out there right now. So we are very much a believer that there will be more IPOs. Of course, we're bankers. We tend to like it when people consolidate and do IPOs. So take all my comments with a grain of salt. But we think that these are the fundamentals that will drive more IPOs over the coming years. And again, create the capital stack that is available for the investments in front of us. I'm going to stop here and take some questions in just a moment. I will just quickly run through a few other points. This slide, lots of words, is basically just talking about what we know is the national security dynamic around AI. And we know that we have this national competition with China and a variety of outcomes that could occur with respect to us placing constraints on China, Trump administration tariffs. Potentially there is backlash on those tariffs. Again, our research team has done some terrific work at looking at the fact that our industry, clean tech industries, do have some risk with respect to the fact that many minerals come from China and are limited. Here are some of the others aggregated in a different way. This slide is meant to have a little bit of fun. I gave it at our utility client conference last year. This gets to the fact that in 23, before powering AI became a big deal, everybody in the industry, whether you're an IPP, you're regulated, you're vertically integrated or not, there was general calm and harmony in the industry. Last year, what we saw is a repeat to some of the times earlier in my career when, despite the pie, or maybe because the pie is getting so much larger, that the participants are not having as much fun playing nicely as they ought to. So that's something to be obviously aware of, and from my perspective, concerned about that we can't be divided here. We have to find a better way, again, around policy solutions to keep the industry together. Here's a provocative idea I'd throw out. I didn't do a good enough job earlier making the point, perhaps, on the on this impact of C&I customers and the point that they drove the last 80s and 90s revolution in regulatory thinking by creating competition. This time around, it's all about reliability and speed to power. And so I just query, will our industry head to a model, and maybe this is actually a good thing for retail ratepayers, where although, as always, if you know me, I try to have some fun in the graphics, we effectively have two classes of service in this country. There's a first class, high reliability, the 5 9, so forth, that we know that big tech needs for their reliability, and we get big tech to pay for it. And again, I'm saying that in the nicest of terms, to the extent to which this gets out there in any way. But again, if you're going to ask for more services, you have to pay up for that first class price and keep the rest of the customer class while we're all flying together, if you will, in the same plane. Their prices will not be as high as those that the C&I customers can and will need. I'd like to end by calling out Marcus Wilhelm and what he has done here at Strata Clean Energy. To my mind, it is the example of the new paradigm of the kind of company that we need in this sector. It's one that has all the aspects within one company of what it takes to be successful, whether those are EPC capabilities, development capabilities, regulatory capabilities, being fuel agnostic, and obviously having best-in-class management. Marcus, I want to end my prepared remarks thanking you for what you have done for our industry and obviously what you've done in helping create this conference today. Thank you so much. We got 10 minutes for some questions if we've managed to kick up some questions.
Thank you so much for these remarks. I'm Ian Hitchcock, a researcher with the Stanford School of Public Policy, and I'm curious about the kind of levelized cost of energy calculations that you showed before, where I agree certainly that renewables on average do appear to be cheaper, but I've come across some research that suggests that the need for firm dispatchable power, particularly from data centers, might make things that are more clean, firm, easily dispatchable sources of energy kind of more attractive for these hyperscalers. And I'm wondering, from your standpoint, if you're seeing any efforts to kind of adjust the levelized cost of energy calculations to account for kind of grid dispatchability and services, in addition to just kind of the cost per megawatt hour.
Yeah, it's a great question. And I am completely incapable of answering it in detail because I'm not a tech guy, but you're exactly right. Look, LCOE calculations are just intended to be broad indications of where technologies and so forth. You're completely right that the actual costs that are going to get paid at data centers for the kinds of specialized equipment that is needed will drive up those costs. Batteries are critical, from my understanding of how they can help deal with the high load fluctuations. Again, those of you that are more technically fluent, I'm sure are aware of this, and it's been talked about elsewhere at yesterday and today's conference. But that is a key issue. I think it's one that is going to impact whether you're front of the meter power, whether you're behind the meter, building out those solutions. But yes, it's nothing is going to be quite as simple and easy. I'm simply trying to make, the only point I was trying to make really just from again, to put it out there, is that we are no longer in the situation which has been, honestly, my entire career was gas-fired power, coal-fired power was the cheaper power, and renewables was always swimming upstream against that. God bless, we are not in that situation any longer. That's the real point I just wanted to make.
Just out of curiosity, what has prevented the consolidation, the coming consolidation that you spoke about to date? Meaning I've seen like National Grid Renewables, Duke Renewables go up for sale, Brookfield buy them, run them as separate, investment portfolios, but not really seeing any big consolidation yet. What is preventing that from happening?
Really good question. So a couple of things. A big part of it is the fact that with ESG, it's a little bit of beware of what you wish for, or you could argue a law of unintended consequences. There is so much money that has gone into the ESG investing theme over the last 5-7 years that every infrastructure fund complex, every private equity firm has wanted to have their own platform. Everybody wants to get in the game. And so because renewables development on a relative basis to gas or nuclear is a lower cost of capital, easier business to start up from an entrepreneurial perspective, it's been easier to get this proliferation of companies that have been created. And we're now at that point where the challenge simply is sort of everybody has made their bets, and now it's who's the seller, who's the buyer, social issues along those lines. I think we obviously are waiting for the policy uncertainty. I think we would have started to see this consolidation last year if we hadn't had the change in administration and the uncertainty, but obviously people need to understand what the rules of the road are with respect to tax credits or not. Different portfolios are affected differently by that. So our expectation is once we get that policy uncertainty hopefully removed in the next several months, that then we're going to have a relatively level playing field for the next several years. And at the same time that we are running out of money in the private equity side of pure common equity investments, not to get too into the weeds, but all of this CapEx with the rules of the road set should now better allow people to say, hey, we've got to get together. We've got to drive cost efficiencies. We can't support 28 different companies all trying to raise capital for our renewables at the same time, again, within the private sector or the private capital where it comes from. I just want to emphasize that the data center investment folks and the renewables investment folks all report up usually in these organizations to the same real asset managers. And so they're allocating capital between them, and they are going to start to say, hey guys, we now have this new asset class, data centers, in a much bigger way. Obviously, the asset class has been there, but the opportunity around AI, these enormous investments that are there, you can't keep up. So, figure out who your dance partner is, consolidate so that we, across our organizations, just have a better investment in front of us.
Hi, Jacob from Gordon and Frost. Thank you for the insightful remarks. I guess a question for you is, you alluded to the fact that primarily data center build out is constrained by policy issues, even by potentially human capital to be able to do it. But when you're looking at the forecasts of the compute capacity that's going to be coming online through the hyperscalers, how does the team view that relative to the industry demand for compute capacity as they adopt more AI into their operations? How far off are we in terms of the demand for compute capacity versus what is forecasted to be brought online?
That sounds like a question I'm not capable of answering again. You guys are doing a good job of figuring out what I don't know. I'm not smart enough on the tech side of that to know. Again, I'll just default to the earlier slide. And I've been fortunate to be in a lot of these discussions with the C-suite out in Silicon Valley, the Mag 7. They need all the compute they can get, either directly or through, folks like OpenAI and so forth. So we don't see that. And again, if you believe our research folks from the return profile I was looking at, we don't think that there's going to be any lack of desire, if that was part of your question, or need to get at this.
Yeah, hi. Yeah, JP Moscarella here. Excellent presentation. Loved it all. One of the things that caught my eye is you show new build combined cycle. I'm a recovering developer, so I've done this a lot, as being more expensive than solar plus storage. Mm-hmm. And what we know from the industry is that gas turbines have a 4-year, 5, or they're just very difficult to get. Mm-hmm. And then you show gas turbines having a slightly higher ROI or return mm-hmm. than the renewables. Mm-hmm. Why wouldn't renewables just go to what the market can bear in pricing terms and get a better return? I mean, isn't there going to be some kind of arbitrage there when renewables say, hey, I can deliver a solar per storage like Strata can do really effectively and quicker than the natural gas guys. So why can't I charge you more? Like your first class plane analogy.
Yeah, I think that's certainly the...
you have a crystal ball of how we're going to do with the gas turbine.
Yeah. Look, I think I think when there is a direct relationship for an AI installation. I think that will be the case, and that is the case. We know that from the client work we are doing. The issue is more broadly, right? And big tech is playing at this from two different angles, if you will. There's what they have primarily been up until now, is they have, because of their sincere ESG commitments, they've obviously been signing the long-term PPAs to commercialize wind and solar, but they've been doing it as an offset, right? Just driven solely by those environmental goals, not the way AI is now forcing them, which is it's existential for getting their business model built. And so when it's the latter, and you're tying it directly to that new compute coming online, you absolutely can get those higher returns. The question will be for the non-compute related contracting that big tech and corporate America does, and this gets back to my point that you simply can't have the 28 private guys that are out there plus the publicly traded guys all competing against each other to drive down returns simply because, at least in the past, you were able to get funding from a PE or InfraSun backed sponsor. Does that make sense? So it's a bifurcated world. It's going to have to change. And I will end because I see that I am being hauled off the stage, as I knew I would be. Again, we're incredibly optimistic on what the prospects are for if we can get this all done correctly. Thank you very much.